The U.S. market is currently closed. As of the last market close on Friday, October 24, 2025, Opendoor Technologies, ticker OPEN, finished the session at $7.97. That was a massive surge of 13.37%, or 94 cents in a single day. The momentum hasn't stopped. In pre-market trading right now, the stock is already up another 3.51%, trading around $8.25 a share. When you see a chart like that, a 13% daily gain followed by another 3.5% jump, the immediate expectation is that the company must have just announced something transformative. Perhaps the iBuying model has finally cracked the code, profits are exploding, and the housing market slump is officially over. The reality, however, is far more complex and, frankly, much more speculative. That surge isn't necessarily tied to a sudden fundamental improvement. It's being driven by a powerful narrative, a new high-profile CEO, and a massive wave of retail interest that has all the hallmarks of a classic meme stock rally. The expectation is that Opendoor is fixing its business. The reality is that the stock's price action has become almost completely detached from the company's underlying financial performance, setting up an intense conflict as we head toward its next earnings report. Let's establish the common ground. It's easy to get excited about Opendoor right now. The stock is up an astonishing 1,300% from its 52-week low of just 51 cents. This isn't just a small recovery, it's a parabolic move that has attracted traders using everything from the Robinhood app to more sophisticated interactive brokers trading platforms. The general belief is that Opendoor has found its footing. The catalyst for much of this optimism was the appointment of Kaz Nejatian, the former chief operating officer of Shopify, as the new CEO back in September. The market loves this move. The belief is that he will pivot Opendoor away from the capital-heavy, low-margin business of flipping houses and toward a high-tech, capital-light marketplace, using AI to power valuations and operations. This is the story investors are buying. It's a story of a tech company, not a real estate company, which commands a much higher valuation. But here is the challenge to that belief, and it's a significant one. This rally is running headfirst into a wall of difficult fundamental realities. While the stock is soaring, Opendoor's actual business was, as of its last guidance, projected to shrink significantly. The core iBuying business model, using data to make cash offers on homes, doing light repairs and reselling them, is the very model that competitors like Zillow and Redfin famously abandoned because they concluded it was too risky and capital-intensive to ever be consistently profitable. Opendoor is the last major player standing in that field. And while investors are betting on a new AI-driven future, the company's immediate financial forecast tells a different story. For the upcoming third quarter, which they will report on November 6th, management guided for revenue to be between $800 million and $875 million. That sounds like a lot, but it's a sharp decline from the $1.57 billion in revenue they posted in the second quarter. Worse, after achieving a celebrated tiny sliver of adjusted EBITDA profitability in Q2 for the first time in 3 years, the Q3 guidance is for that to reverse, forecasting a loss of between $21 million and $28 million. So, what we are watching with this 13% daily gain is a massive disconnect. The market is pricing Opendoor like the next NVIDIA stock, betting on an AI-fueled narrative. But the company's own guidance suggests its core operation is hitting a severe air pocket. This recent trading volatility is less about spreadsheets and discounted cash flow and more about social media buzz and a fear of missing out. We saw institutional interest add fuel to this fire when Jane Street Group disclosed a 5.9% stake in September, which many retail traders, perhaps using SoFi Invest or a standard individual brokerage account, took as a major vote of confidence. This has created a feedback loop. The stock rises on the AI narrative, which draws in more retail traders, which forces short sellers to cover, driving the price even higher. This is happening despite the fact that the macro environment for housing, while improving slightly, remains very difficult. Mortgage rates have thankfully eased for 3 straight weeks, dropping to around 6.19%. But Opendoor's own management stated in August that they don't anticipate a broad housing market recovery anytime soon. Let's look at what the company actually does. The original concept was simple: provide certainty and speed to home sellers. Instead of listing a home and waiting for a buyer, Opendoor's algorithm gives you a cash offer in days. They buy the house, take on the risk, and try to resell it for a small profit. The problem is that their gross margins are razor thin, recently sitting around 8.1% to 8.3%. In a stable or rising housing market, that model can work. In a volatile market with rising interest rates, it's a recipe for disaster. If you buy a house in July and the market drops 5% by the time you're ready to sell it in September, you've wiped out your entire profit margin and then some. This is what nearly bankrupted the company. The new CEO's proposed shift, announced during the Q2 call, is to move toward a distributed platform. The idea is to stop relying solely on Opendoor's own balance sheet and instead empower third-party real estate agents with Opendoor's cash offer tools. This would turn Opendoor into a platform, moving it toward a capital-light model that investors find much more attractive. This is the bull case. This is the entire story. The question is whether they can execute this shift before their cash burn from the legacy iBuying model becomes too much. Many investors looking for investment help might be directed by a traditional Fidelity wealth management advisor to look at Fidelity mutual funds or Fidelity ETFs that track the broader real estate market precisely to avoid this kind of single stock volatility. But for those engaged in self-investing, Opendoor represents a high-stakes gamble. It's the kind of stock that has more in common with Tesla stock in its early volatile days than with a stable blue chip like Apple stock. People aren't just buying the company, they're buying the story of its new CEO. The Q2 earnings report was a perfect example of this mixed reality. They beat analyst expectations on earnings per share and revenue. And they delivered that small positive adjusted EBITDA. Those were real tangible wins. But buried in that same report was the deeply pessimistic Q3 guidance, which the market, in its current euphoric state, has chosen to completely ignore. This sets up a massive potential catalyst on November 6th. The expectation, judging by this 13% rally, is that the company will either smash its own weak guidance or provide a new rosy forecast for 2026 and 2026, confirming that the AI platform pivot is already working. The reality could be that the company simply delivers the poor numbers it promised, a sequential drop in revenue and a return to unprofitability. What happens to a meme stock when the fundamental reality it has been ignoring finally arrives? We could see extreme volatility. This is why having a diversified approach, perhaps through Schwab Intelligent portfolios or a basket of stocks on investing sites, is so often recommended. A single name like Opendoor can make or break a portfolio in a single session. Many are likely checking their Fidelity mobile app or Robinhood cash management accounts this morning, thrilled with the pre-market gains, without looking at the Q3 guidance that looms just over a week away. The future outlook for Opendoor, therefore, is binary. There are two distinct paths. Path 1 is the bull case. The new CEO Kaz Nejatian is a genius. He successfully transforms Opendoor from a clunky, low-margin house flipper into a sleek, high-margin, AI-powered real estate platform. The agent-partner model takes off, revenue becomes capital light and high-margin, and the stock's current valuation is justified as it grows into its multiple. The 1,300 run from the lows was just the beginning. Path 2 is the bear case. The AI talk is just a narrative. The new CEO can't change the fact that the core business is fundamentally flawed and bleeding cash in a tough market. The Q3 earnings report on November 6th is a disaster, missing even the lowballed guidance. The retail fervor breaks, the meme stock collapses, and the stock crashes back to earth, proving that Zillow and Redfin were right to get out of this business. The company's $5.9 billion market cap, built on hope, evaporates when confronted with the reality of its income statement. This is a true high-risk, high-reward scenario that defines the modern market for online investing. It's a story that will be traded heavily on platforms like SoFi Active Investing and Interactive Brokers platform, due